Hi, I wanted to record a short video going through just a few examples that we did in class together yesterday. I know you couldn't be there, so I wanted to give you a chance to take a look at this. So the first thing that we did is we went through this chart at the top of the page, and you'll see that there are different accounts listed down the left, and then it says account type and whether the normal balance is a debit or credit. So we're talking about account type. I'm asking if it's a dividend, an expense, an asset. Those have a normal balance on the debit side, or if it's a liability, owner's equity, or revenue account. Now, owner's equity consists of, for what we've been covering, common stock and retained earnings. Okay, so that's that DLOR acronym. Anything on the right side, liabilities, owner's equity, and revenue, is going to have a normal balance on the credit side. We did this so that we could review some of the terms that we've been using, the account names, so that we could do a refresher on when you have a debit and when you have a credit in an account. And then also it kind of leads into the journal entry that we're going to do in the next question. So prepaid insurance, we have prepaid our future expense, right? We own the right to have insurance coverage. That is an asset. That's something we own. It's an asset. Like I said, the normal balance in an asset account is a debit account. If we go down through this list, you might see land right here is also an asset account, and that has a normal debit balance. Accounts receivable, money that we expect to receive from our customers, that is also an asset with a debit balance. Okay, now coming back up here to accounts payable. If you look from the perspective of the company, account receivable is money we expect to receive. That's an asset. Accounts payable is money that we have an obligation to pay. We owe someone that money, which makes it a liability. Liabilities have a normal credit balance. Okay, common stock. If we look, it's not an asset or a liability. It's not a revenue or expense. It's not dividends. Common stock is an owner's equity, which is on the right side of that accounting equation we've been dealing with, which means it should have a credit balance. So we've got owner's equity, and we would have a credit balance. Okay, utilities expense, as the name says, is an expense. That's on the left side, DE for expense A. On the left, which means its normal balance is on the debit side. Services revenue is that R on the right side, DLOR. Services revenue, rental revenue, interest revenue, all of that would fall under revenues, and we would have a credit balance. Now, the one thing to watch for, we have another revenue account down here. Okay. The issue with unearned revenue is we don't recognize revenue until we've earned it. So if you have an account called unearned revenue, that means you have a liability account. So if we think about that in terms of like a lawn service, maybe I prepay you for the summer to mow my lawn. You owe me those lawn mowing services because I've already paid you. So you're going to record that as unearned revenue as a liability, and then you're going to adjust that as you earn the revenue to recognize the revenue. So liability account, we would have a credit balance. Depreciation expense is an expense, just like D, utilities expense. So we're going to have an expense and a debit. Okay, so accumulated depreciation is the one that's a little bit weird. It's not a revenue, it's not an expense, it's not dividends, it's not owner's equity, it's not an asset or a liability. It's a contra asset account. Okay, it's a contra asset account. That means an asset account has a normal debit balance. A contra acts opposite to or contrary to that asset account. So it's going to have a debit balance. And we're going to see that with accumulated depreciation. There aren't going to be a lot of accounts like that. We are going to do a depreciation one together a little bit further down. But first, let's take a look at this electricity bill. Okay. So when you're doing a journal entry, one of the things I recommend to students is before you do anything else, you're using pencil, right? So there's no fear in making a mistake that you can't erase. I would take a minute and say, okay, this happened on December 14th, 2020. Let me get the date down. Okay. The only amount that I'm dealing with in this transaction is $400. So let me get my debit and my credit dollar amount down and in the right spot. Okay. You also, as you're thinking about what this journal entry says, received its electricity bill and paid the bill on December 14th. Okay, so we could put the description right here as you're thinking about what the accounts might be. To record payment of utility, we'll do electric. Okay, so we're paying a $400 electricity bill. That's what we're doing with this transaction. If we are paying the bill, okay, we're immediately paying the bill. We are using cash to pay that. If you pay your rent, right, and you give them a rent check, you're paying with cash, even though it's a check, right? Nothing on here says that we're paying on credit and we'll settle the bill in the future. We're paying it right now. So you can assume that that's going to be cash. All right. And not an account payable. Now, for the account name for the debit, we have used up the electricity for the last, let's say, month. Okay. When we spend money on something that helps us do our business, whether it's to pay our employees or to keep the lights on or to have water in our building or internet services, all of those things are used up in the course of the business. So we don't have an asset. We're not paying for electricity that we're storing and keeping for future use. So we're going to have an expense. You can call it electrical expense. I'm going to call it utility expense. Okay. All right. And that's a journal entry. All right. So if we come down here, I'm going to add one little note. I'm going to add a salvage value in here of $2,000. That's what we did in class. It just makes it a little simpler. Okay, so Fred Company bought a $42,000 piece of machinery and put it in service on July 1st, 2020. The machinery is expected to be sold for $2,000 scrap at the end of its useful life in 5 years. So if you remember, depreciation, straight line depreciation, is going to be equal to the purchase price minus the salvage value divided by the useful life. Now on this one, I tell you that they bought it on July 1st, 2020, which means there'd be 6 months till December 31st, 2020. See how in bold I put December 31st, 2021? That's when we're recording this journal entry. So you actually have an entire year of depreciation to record in this adjusting journal entry. But I've given you an additional piece of information. Whenever you see something in bold or underlined or in italics, just stop for a minute and look at why did I do that? Why did I bold that? Why am I calling your attention to that specific piece of information? For this journal entry, you do not have to do 6 months only, and you don't do 18 months, okay? For depreciation expense, we record it in the period that we're dealing with. We're not recording for prior periods as well. Okay, so our depreciation is going to be equal to $42,000. You see why I added this $2,000 salvage value. $42,000 minus $2,000 divided by a useful life of 5 years. So with depreciation, we're figuring out what the value of the asset is that we plan to use up in our business. We're not going to use up that $2,000. We're going to get that at the end of its useful life. So we've got to spread the other $40,000 over the time that we're going to use it for, and that's 5 years. So we're going to do that by recording $8,000 of annual depreciation expense. In 2020, on December 31st, 2020, we would have only recorded $4,000 because we used it for 6 months. Okay, the other $4,000 will come, from January to June in that very last year that we use it. But for the year that we are dealing with, we've got December 31st, 2021. We are going to record a debit to depreciation expense, but we're always debiting our expense accounts. Okay, and we're going to credit a contra asset account called accumulated depreciation for $8,000. Okay, sorry, put that in there. So this is to record 12 months of depreciation expense for machinery. Okay. So this is a formula I would make sure you know. We've looked at it a couple times now. I would make sure you're comfortable with this adjusting entry. That accumulated depreciation is a contra asset account, so the normal balance is on the credit side. Let's see. Okay, so I told you you wouldn't have to prepare financial statements from scratch, but I did want you to know the name of them and the time period covered. So first we prepare the income statement. The income statement has our revenues minus our expenses, gives us our net income. Those are our temporary accounts. Remember from chapter 3, from the closing process, I said make sure you know the temporary versus the permanent accounts. So these income statement accounts, revenue, expense, the income summary that shows our net income, those are closed. Revenue expense accounts are closed to the income summary. The income summary is then closed to retained earnings. And our retained earnings is also affected if we have any dividends. Dividends will reduce the amount of retained earnings we have. So the income statement needs to come first, and that covers a period of time. It shows all of the revenue and expenses, let's say for a year, for 12 months. At the end of the 12 months, we zero those out, and the next year on December 31st, we show the revenue and expense account balances for that second year. We don't carry over prior amounts into the current period on the income statement. Next, we're going to prepare the statement of retained earnings, which is also for a period of time. Retained earnings takes your beginning retained earnings plus any net income. If we have a loss, if our expenses are greater than our revenue, then we would subtract out the net loss. And then we need to subtract out any dividends, because remember, dividends are money that we take out of the business and give to our shareholders. It's not retained, right? We've taken it out of the business. So that would logically reduce retained earnings. Okay, once we get the statement of retained earnings done, we need to know what the retained earnings are, because those amounts, retained earnings is a permanent account that goes on the balance sheet with the other permanent accounts, like assets, liabilities, and the other owner's equity is common stock. Okay, so in our balance sheet, we are covering a point in time. This is the only one that's as of a point of time. So it's our balance and our asset accounts on December 31st versus the income statement that is as of, for our income statement that is for the period ending December 31st. Okay. Then the last thing we have is the statement of cash flows. You don't really need to know what's going on with that other than that it just shows our cash transaction. It summarizes that information, and that it is also for a period of time. And we do our statement of cash flows last. Okay. All right. So I hope that was helpful. I'm going to pause here for a second. I'm going to open up some slides and just point out a few things from chapter 1 that hopefully you got in your notes, but it's been a while, so I'm going to make sure you look at them again. Okay. So I apologize if you can't see the slides, but I think I've got the share set up so you should be able to see them. So I've opened the chapter 1 PowerPoint slides, and if I go down through this, one of the things that we talked about in chapter 1 was ethics on slide 9 of the PowerPoint slide. So make sure you review that ethics is our standards of good and bad behavior. Ethics are beliefs that distinguish right from wrong, and good ethics are good business. It's an important part of accounting and all business, but especially accounting because we're representing to the public that we are trustworthy, right? That we provide valuable information and it's been checked. It's accurate information. Then on slide 10, we talked about the fraud triangle: opportunity, rationalization, and pressure. Don't worry, if you spell something wrong, I'll still grade it. Also, I occasionally have students tell me that they don't want to give me a garbage answer, that they knew what they thought the answer was, couldn't be right, so they just left it blank. Give me something that I can grade. Even a partially completed journal entry is better than a blank page. And a blank page is easy for me to grade, but 10 points over the course of the semester from partial credit in a 500-point class can be really material and help your grade. I asked in chapter 1, and if you've already watched the other review video, you kind of got this. Just know what FASB is, know what GAP is on a high level, know what it stands for. So you could answer a simple multiple choice question if that's up there. And then especially wanted to point out slide 18, that proprietorship, partnership, and corporation, the different types of entities, the structures, the organizations for those, what that means. Okay. I think that you want to make sure, the financial statement, a question that we just went through, if you look at slide 45 from chapter 1, it lists out the 4 financial statements in a really easy to access summary. So I would take a look at that. Most of chapter 1 is not that useful because we did those same journal entries in chapter 2, and I think that those are going to be more useful for you now that you've got more experience with accounting. Keep in mind that the handout we did in class together is also from the homework and is based on those same chapter 1 and chapter 2 journal entries. So if you wanted to, you could go in and launch a study attempt for the chapter 2 homework and go to the one that just has a long series of transactions and just practice a couple of journal entries. That way you can check your work as you go, but you don't redo the financial statements, right? Those are to help you get familiar with everything. And I think your time's probably better spent slightly differently now. Chapter 2, we talked about liquidity and solvency on slide 5. We talked about source documents, what an account is, what the general ledger is. There are some examples of different accounts here. And this chapter is really where we covered the usual balance and dividend, expense, and asset accounts is on the debit side, right? Any additions you would debit, any subtractions you would credit. For the liabilities, the owner's equity, like retained earnings and common stock, and the revenue accounts, you're going to credit them to increase the balance of the account. The beginning balance would be a credit. The ending balance would be a credit balance. So that was really what we got into in chapter 2. And there were a lot of transactions that we worked through throughout the class. Let's see. We talked about a point in time versus a period of time and what the financial statements are called. That was also a big piece of chapter 2. And then in chapter 3, that's where we got into the adjusting journal entries, including depreciation and knowing that depreciation calculation, right? The purchase price minus the salvage value divided by the useful life. And then the closing process, I said I wouldn't necessarily make you close, but you should understand the basics of the closing process. And we close the revenue accounts, we close the expense accounts, we figure out the net balance in the income summary account, we close that to retained earnings. And then we close our dividends if we have any to retained earnings. No temporary versus permanent accounts. That was in chapter 3. The depreciation calculation was in chapter 3. You don't have to memorize the accounting cycle, but you should just generally kind of know how it goes. That temporary versus permanent was on slide 49. The closing process only applies to temporary accounts. The accounting cycle, like I said, you got to know that you get your source documents, you record your journal entries, you post to the accounts, and then you can prepare your adjusting journal entries and your financial statements, and then you can do your closing journal entries to kind of clear everything out in your temporary accounts and make them ready for next year. All right, well, I hope that this is useful. I didn't want to leave you out since I knew you couldn't be in class this week on Wednesday when we did our review, but I don't want to overload you with information. So if there's anything you think of that you have a question on, please let me know. Otherwise, I will just plan on letting you take the test online and we'll go from there. If you do have any issues that would keep you from taking the test because you are unwell or something else is going on, please, please, please let me know as soon as possible so that we can figure out